Good morning, everybody. Welcome to the Flow Show. Here we are, Wednesday, 11th of September. If you can, during your trading day, I just want you to take a moment for the tragic events that happened in New York this time many years ago. I know I was up there trading, and OK was up there trading at the same in the city at the same time, or in the market at the same time. It was a terrible event. Lost people I knew. I'm sure Kay knew as well in it. So just take a moment to reflect on that. Sometimes there's more important things at stake than trading. And just take things on a more cheery note. Morning, Kay. Back from, semi-back from the lurgy, I see.
Yeah, semi-back, mate. Semi-back. My voice is slowly coming back, so we'll try to get back into the saddle here.
Yeah, no worries. I won't
And
ask you too many questions.
and I join your thoughts for those events that we had, the towers and everything. So yeah, there's much more important things in life than trading. So please take a moment to reflect on that.
Yeah, thank you, mate. Right then, let's get stuck into things. We got a familiar pattern happening with the Bank of Japan and the yen. It seems during the day we trade pretty much everything else other than what's going on at the Bank of Japan, and then up pops a Bank of Japan member just to remind everyone that potential rate hikes are still there and ready to go as and when they see fit. We had a Bank of Japan member, Nakagawa, up last night saying the achievement of the wage inflation cycle is in sight. And he says that given real interest rates are currently very low, we will adjust the degree of monetary policy from the standpoint of sustainability and stably achieving our 2% inflation target. He adds on the caveat we've heard from pretty much all of them: if our economic and price forecasts are met. So all these BOJ members keep coming up with the same lines, that they're ready to go if they get the data that they need to. He says the future rate path depends on the economy and price developments at the time. He says it's hard to pinpoint a level of neutral rate policy or neutral policy rate. Now, he speaks just after we got that headline and that sources piece saying that the BOJ is unlikely to hike next week. So, as I say, these little pop-ups from these BOJ members just gives the market a little nudge that the Bank of Japan is still in the game on this front. Over at the RBA, Assistant Governor Hunter said the outlook is highly uncertain, but our forecasts are likely to be wrong in some way. Doing a bit more than Bullock's been doing in saying that things are a bit more uncertain over there. He was waffling on about the jobs market, saying it's in better balance now and they're going to look for the risks and whatnot, nothing else on the monetary policy and whatnot. Over in the UK, we had a bit of data out, and not good news for the new government, seeing GDP and some of the other data coming in much softer. GDP for the month of July coming in flat, was expected to go up a whopping 0.2 pips. There was a better number in the year-on-year number, but that missed expectations. We got industrial production and manufacturing production numbers, which went on a bit of a reversal to what we saw last month. Was expected to come in more, it was expected to come in negative on the year, positive on the month, but it came in negative pretty much across the board through manufacturing and industry. The 3-month rolling GDP number there coming in at 0.5%, again a little bit lower than 0.6%. This is a rolling quarterly number, if you will. Trade balance got a little bit worse there, deficit down to up to 20 billion there. Construction output as well looking a bit soggy as well, but it hasn't been doing all that great of late, but negative numbers there too. Not that you'd really know it in the pound, not really had an effect on the pound as such. We're still walking the same old ranges, cable and euro sterling and the like. We've got BOC's Macklem out yesterday as well. After their meeting, the shackles are off. They can speak to their heart's content. Macklem came out talking about jobs, saying that a big change in layoffs would be a concern, and that the August jobs data was a continuation of the pattern. He wants to see a pickup in jobs growth. He said policy is not on a predetermined path, but bigger cuts are possible if the economy and CPI is weaker. He sees some downside risk to their Q3 GDP estimates, so a bit of a warning signal there. There's a poll out from Reuters on the Fed and what they're going to get up to next week. 101 economists were polled. 92 say they're going to cut by 25 pips. 9 are still saying they're going to cut by 50 pips. We'll see which way that goes next week. Over in oil, OPEC cut its oil demand growth forecast to 2.03 million barrels per day. The prior forecast was 2.11 million. They also cut 2025 forecast to 1.74 from 1.78. And they said their production in August averaged 26.59 million barrels per day, which was down 197,000, led by what happened in Libya. Politics, this shutdown business, I'm keeping an eye on headlines there. There is one speaker who's put forward a plan which doesn't look like it's going to get much cop. What this guy's doing is tying things up together. So he's tying one thing up with something else. In this deal put forward, they want a 6-month continuing resolution added with a bill that Trump supports that would require proof of citizenship to vote. So there's a bit of horse playing going on, which isn't going to go down too well coming into this election last month. So we'll see how that develops anyway. And staying on politics, over in Mexico, the Senate will discuss this judicial reform proposal on Tuesday. So I think that's next Tuesday. And we'll see what that brings, if there's any news from that one. A bit quiet us on the news front. Kay, anything you want to add? I thought I'd get through it all to limit your voice.
Yeah, in regards to that Mexican thing, looking at the majority that Scheinbaum and then before AMLO had, I'm a bit doubtful that they would vote it down, really. So perhaps the Mexican market is preparing for that to be voted through, which would be, of course, a biggie next week. In other news, I saw that in Germany, it's still not getting really great because there's been another this year. Let me find the headline back. We saw like a big increase in the number of insolvencies in Germany as well, and at the same time, Volkswagen said or told the union IG Metall unions that they are canceling some agreements as well. So it's all going still a bit negative in Germany. That's the other thing I saw, and I trust you're going to talk about Harris and Trump right now.
No, I haven't seen it. I haven't watched it. And
Oh, okay.
I don't care about it. if you've got anything to add, mate,
Yeah.
feel free.
Yes, I do. I think you have to look at what the Swifties are going to do. I think that's the biggest news coming out of the debate is that Taylor Swift is going to support Harris now. And that's it.
Yeah, that's it. If that's the biggest news that comes out of a political debate, then we're all screwed, really. Right, yeah, on that German thing, I've seen a few tweets this morning. This Volkswagen stuff could cause a bit of problem for them, for the unions, for workers. One of the things that may happen is if this agreement, this working agreement cancellation, if that's not resolved or sorted out by a certain time, then apparently an agreement from 1994 takes over, which would mean pay hikes for all those involved. Don't ask me how it's going to work out, how you give people pay hikes if they're going to be losing their job with these shutdowns. But that's Germany for you. So
exactly.
we'll wait and see.
I don't think the 1994 agreement is guaranteeing anyone's job over there.
No, exactly. But as you say, it just highlights the strife that the Germans are in at the moment. And that's why they'll be calling for rate cuts pretty pronto, get the economy moving. Right, big event today is obviously the US CPI data. We are expecting a pullback in headline inflation, 2.5 on this expectation. Others have it at, I've seen 2.6 as well. So either way, we're expecting a pullback in headline inflation to 2.5%. The core, that might be the more interesting one. That's expected to come in unchanged. Usual rules apply for this one. It's going to be the degree of variation that's going to increase or decrease the market moves around it. Now, CPI, if we just take that headline number, we finally got below the 3% mark, and it's still been a bit sticky, but it has perhaps started to trend the right way for the Fed. If we get a big move down, if we get that number closer to that 2% handle, then that's going to probably get the market dubs squawking again, chirping again, and we may see again a pickup in the 50 basis point hike expectations. Same thing with the core. If we see a big drop in that to maybe 2.5, something like that, again, that will get the market doves up, and we'll see this pendulum swing again to the 50 basis point cut. I think the same thing applies to this as it has all the way through. Any big pricing towards 50 pip cuts is unjustified. And as we saw from the NFP last week, the market tried to go one way, and then the sensible head said, no, this isn't 50 pip stuff, and took it back the other way. What we are seeing, just before I bring Cayman into asking about this data, and as I've been saying for the last couple of weeks now, what we're seeing in markets isn't just 50, 25 pip moves. You get that short term around the data points, the big data points. But as you can see, we've had no data, and yet yields are still falling. And we're seeing yen pairs particularly taking note of that as well. Other dollar pairs are staying pretty steady. So it's just showing you that there's a lot of movement into bonds at the moment, locking in yields, going long on positions, take your pick. But these are the big flows we're seeing at the moment, and they trump everything right now. So until we see that stop and the market either get into a better balance when everyone's finished loading up and getting long or whatever, then there's a risk that we still see yields continuing lower and the data adding to that movement as well. So when we get to the CPI, trade the CPI for what it is, trade the short-term moves for what they are, if you so wish, but know that whatever happens, this is unlikely to reverse anytime soon. So if you get a jump in yields, it's likely that's going to be hit. If you get a jump in the dollar yen, it's likely that it's going to be hit. That's been the theme for several weeks now. So whatever way you trade the data, be mindful that we will revert to the bigger trends and moves after. Kay, what are your thoughts for CPI today?
Yeah, I'm just trade the number. If it confirms the lower print, I would say, that we saw in other data. I think we need to take inflation with other data right now. If we confirm the path lower, this yield play will probably continue. I'm not sure down to where, because we have now, since the highs in yields, if you go back stay there. We are now pricing in about 7 cuts, which is, what is it, 175 BPs. And I'm not sure we can get too much lower. I do have some levels coming up around 330, which would add another one. But I think that would be kind of enough for this round, unless we see other economic data point to lower, and let's say, for instance, growth data pointing to lower levels, that would, in my opinion, do another leg, and then in fact weigh on the dollar, because it's still the biggest market yeah, out there. So it's also the biggest bond market. We have seen Japanese, for as long as the Bank of Japan is not doing more with the yields with rates over there, we have seen them massively buying foreign bonds. So they are weighing on those yields. They really putting their money to work, and try to be on the long side of the bond market right now, until they will then repatriate home. But that's perhaps the next leg. For the rest, yes, trade the number for what it is. It does appear, if you bring it back to the dollar, that we have seen a correction in the dollar, because all yields have been coming lower. But there's some selective currencies where I think we're on some levels where it's going to be interesting to look at the other side again, because if the rate move continues in the US, I can see some currencies starting to do better. Not particularly thinking about the euro, but then I'm thinking about perhaps commodity currencies, which have seen quite a big setback in oil and everything. But if we could see a continuation of the US yields and data coming down, I think some of those currencies may start to be interested to have a look at again, for picking up the move that they started weeks ago.
Yeah, I think the dollar's been a bit strange, because obviously it's been falling in versus the yen, not doing an awful lot versus anything else. As you can see from that, we're not doing too much at the moment. You know, I'm looking at the Dixie purely just for an dollar overview, even though it's more euro dollar than anything else. But as you can see, we're not busting any sort of moves. Even yesterday, no huge moves going on here. But that might pick up if we really start to see the data going. Then we might get a bigger sell-off in the buck. But right now, some people are calling it a risk move. I'm calling it more a global growth worries move rather than risk. But there are risk elements to it. We're seeing gold up near the highs again, but it's looking half-hearted as we get up here. You know, it gets up and it just seems to struggle a bit. I have taken a small short up here just to maybe play the range with a stop reverse above, and I'll ride that a bit bigger if we do break. But you know, you look around, and Aussie dollar's a key one, because it's a commodity currency as well. So it's going to be affected by the general mood of commodities. You know, copper's not doing awful well, iron's not doing awful well. And here we are, we're just really not doing anything. We're sitting in a 20, 30 pip range for the last few days. That's coming as we're seeing a big drop in yield. So the dollar is a bit mixed, caught in the middle, I think, at the moment, versus other pairs. And really, for trading, you just got to decide what you want to do. We've got this big data coming up. If it's hot, CPI, dollar gains, but Aussie dollar can't break this level again, then that might be worth giving it a go. I was looking at this yesterday, but it really felt like it was going to break, like we saw in a couple of other pairs that were breaking down. You know, cable broke through its support around 130.80s. Looking at that, got under this level again, came down, made a new low, but then we've bounced back up again. This 131, 131.10 is proving to be a bit of a tough nut at the moment. But we're still pretty tight in cable. So your range is probably, you want to be looking at this 131s down to maybe that fib, and go with either side of that move there. Dollar CAD, another one. Got through this resistance, hit the next level up at 136.15.20. Tried it twice, couldn't do it, and now we're back down again. But we're finding support there. So this is all quiet trading when you just find us bouncing between the levels. Again, we haven't gone that far. We were stuck here for a few days. Now we've had a move up and we're staying pretty tight. So if you're scalping, you know, there's pips to be had, but you've got to have a bit of conviction, I think, at the moment, to try and try some of these trades, some of these moves. Dollar yen was an interesting one. Been pointing this out for a long while. We got close to this 61.8 fib, came 20 pips short, which, given the volatility, you might class that as a hold. This was the big fib level down here. It was a level all on its own as well, around this 140 and a half. So it needs to be respected. Again, this is one I'm not happy having positions in overnight on this one. As I mentioned in the chat room this morning, I came in Monday and we were 100 pips higher than we were Friday. Came in Tuesday, we were 100 pips higher than where we were when I left it Monday. Come in today and we're over 100 pips lower than where I left it. So I'm not keen to leave orders. I'm not keen to have positions overnight where I've got no control. But if we see another move, perhaps over the CPI data, if it's a soft one, if we get down there, hold this low, then I might give it a little scalp just to see if we bounce on there. And, you know, the way the volatility is, that can be 50, 60, 100 pips if Friday's anything to go by over the NFP. So that's the way I'm looking to play this one. You got any pairs of choice or assets you're looking at in particular for the CPI, mate?
Yeah, well, I'm basically not far away from those that you're watching. I think gold is one that we've tried a number of times to break out of this range, 70-30, and on the white, maybe, yeah, we had a quick look below 24.90 and then bounced. I think this is one that's not going to need a big miss to finally get going again. The more we test those highs, of course, the bigger the level becomes, but then the bigger the levels becomes as well. If you break it, and if you look at the global thing where ECB is going to cut, where the signs of economies slowing down a bit, it may be your go-to instrument, at least partially. Apparently 4 months that PBOC, but that's only PBOC, hasn't been buying gold, and yet we are still at the highest. So imagine that China comes back into the market. This thing is ready for the next leg. That is just my opinion on a weaker one. And the Aussie as well. And I'm looking at the same level. It's a pretty decent setback level over here. And anywhere between 66.40 and 66, the figure is an area of interest for me in the Aussie dollar now. If that starts to hold, that's perhaps good enough to form a base right now. On the other side of the medal, it's a bit difficult to look at, but I find, on the one hand, I think that, for instance, Swiss has stopped following the yen. This is one that I'm going to have a look at, perhaps to the other side, if we get like sticky or surprisingly higher numbers. But again, I think growth and employment are more important. But still, I mean, the market is going to react on inflation. But if this is sticky compared to the inflation in Switzerland coming out a bit weaker, I think perhaps dollar Swiss is one to look at for the other side of things. And then, yeah, that's about it, mate, because I mean, risk is so difficult to trade. And I'm looking at the S&P. S&P it fell out of bed down to 5,400, decent level, coming back now. We are trading, roughly speaking, 2% below all-time highs. I just can't see how we can call any of those moves risk off. So for me, trading risk these days is very, very very unclear. We've seen a big drop in the oils, but I think that's more an imbalance between supply and demand, and I don't think it's really a risk move. But so it's very, very difficult to qualify or quantify even risk these days.
Yeah, and we were talking in the room yesterday. if we got a pickup in growth worries, and these will be, you know, not just US but global growth worries, and we're getting a big switch into bonds, it's hard to see how stocks, particularly S&P, get back up to those highs in that environment, because it's, you know, we're not trading just you know, rate cuts and cheap money and all that palaver again. We're trading the potential for companies to start seeing lower income, lower activity, lower earnings, which should not be good for stocks. So I would think that if we do get a move up, back up towards anywhere towards these highs, I think, or any decent rally, I think we're gonna start seeing these rallies hit pretty hard. We're already sort of in that mood at the moment, mate.
I don't, how shall I say, disagree with the idea, but we may have to wait. You know, the next jobs report, perhaps, or the next. I don't think this thing is going to be materially sold off on inflation unless we get like an absolute crazy print higher.
Yeah.
But it doesn't look like the market is yet. We're seeing bouts of get me out of here, but it's not your full-fledged risk off yet. Which is a bit, and I find it on so many instruments. We could actually argue that oil is trading recessions, and but then if we start to have a recessionary environment, your stock market has nothing to do up here, and yet it is up here.
Yeah, but then we know how bonkers the stock market is at the moment. So yeah, I think what I'm mainly trying to say with stocks, it might just be a bit of a sword of Damocles hanging over it.
Very possible.
If the data really does turn, and I mean turn from soft landing to crash landing, then as I say, I can't see how stocks stay up here. So yeah, I mean, we've got some clear levels. 55 was a level. It's been a level on the way up now. 55.20 is a smaller level. For me, this is the key level, 55, 55, 65. If we're back above there, then there's every chance we go and have a go at those highs again. But if we got up there and we struggled, I think I'll start piling into some shorts. And it doesn't matter, because I could still reverse it to a long with a stop anyway if we do break. So there's plenty of opportunity here. Would I be buying it down here though? I'm not so sure. I'm not too keen at the moment, as I say, with the risks. So I'd rather have a short bias and a long bias in stocks at the moment, unless we do take out those highs, and we'll take it from there.
Yeah, I think another break below 5380, 5400 is going to signal it probably. But again, yeah, when is that going to happen is my question. Yeah, it's just also to illustrate that risk is trading extremely uneven right now, because we could qualify the yen move as a risk-off move as well, but it's not your pure risk-off move. It's the imbalance between central bank. It's UADA being probably more hawkish than what we would have expected, but he's still not moving faster than we would have expected. But and the rest of the central banks cutting, and yeah, the growth in the European zone, in the Eurozone, is anemic as well. And I'd like to see the next batch of growth numbers in the US. If those start to falter, then I think, yeah, your stock market is going to enter the risk off and lower. Yeah, perhaps the next jobs report as well. I know. Yeah.
Yeah, and Matthew says it's not a recession as such, but investors bracing for a lower growth environment. Yeah, I think that's it. My base case.
They've been doing so for over a year and a half.
Yeah, well, we've been saying it for pretty much just as long, if not 2 years. You know, didn't expect any recessions or major contractions, should we say? Bumping along the ground. It's what we've seen in the UK, what we've seen in Europe. US has been a bit of an exception, but that might be heading down. You know, and as we've explained before, technical recessions are one thing, steep contractionary recessions are another thing completely. And though the market may throw its toys out the pram over a technical recession, if it's not a big contracting recession, then that's a different kettle of fish entirely. Tarek, what if the CPI numbers are higher? As I just mentioned, if these numbers come in higher, then it's obviously going to show stickiness in inflation. But with the Fed seemingly moving its focus away from inflation to the jobs market, it's sort of the lesser aspect now of the Fed trade. So unless we get something silly like CPI going back to 3.1, 3.2 or something like that, the core going up above 3.5%, then the market's probably not going to do an awful lot. We might see just a little bit of a, let's say it's 2.6, 2.7 and 3.2, 3.3 in the core. Then we're probably going to see a bit of dollar buying, yield rallying somewhat. But as I said, that's not going to change the overall picture. And the market will probably hit both of those. So that's what I think what's going to happen with CPI, Tarek, if it goes higher. You're also asking about euro dollar. Bit similar to cable. It's, we had this little move through this 40s area, got down. I've got a, small area there, 110.15. Everyone and his mates waiting down here at the 110s. Certainly I am. And I know a lot of our people in the chat room are looking to try along off there. It's a good looking technical level. It's got plenty of confluence down there. But as always, I'll always judge a move on its merits at the time. I'm not going to sit here now and say I'm going to blindly trade 110. I'll wait and see what's taken us to 110 first. But I have got my eye on that one for a bit of a long. And there's probably going to be quite a few people there as well. So that is the other side of the coin, is that if everyone's looking at it, it becomes a big fat target. So, you can't rule out having a little flush through, knock out everyone getting long before it reverses and then goes back above. So as much as it's a juicy level, it could be a dangerous level as well. For the top side, up into this area, 110.70s, then up into the 90s, 111. That I think is probably going to be a stretch point if we get any really weak data from the Fed. From the CPI. But we'll see what happens there. So there's plenty of ranges to trade, plenty of levels to look at. This is an example. We've come through the NFPs, we've come through other central bank meetings, all of it, and we're still sitting in a pretty tight range. So it's going to take a lot to really kick some of these pairs out of kilter, out of their ranges.
And also euro dollar, don't forget, we are just ahead of the ECB.
Yeah.
So whatever move you may find on today's CPI, I personally am not going to get overly tempted in euro dollar ahead of the ECB. But I'll be rather looking at other pairs. There's one more, which is the Kiwi dollar, where we are in a bit of an interesting area here once more, around the 61 quarter or half, call it, zone. You can see that on Ryan's charts as well. It is a bit, and even before it's a traffic zone, right? So this is one as well that I'll be keeping an eye on over the CPI. I think the commodities are interesting, because you look at Aussie, you showed it, CAD, you showed it, Kiwi, you showed it, and all three of them could be at break zones for a dollar to continue higher, or at zones where you say that, okay, this is enough of a correction, and now we re-attack what we've done since the start of August. So I think we're in interesting zones here.
Yeah, very much so. And I think going back to S&P, that's also a good case in point to remember the context of any moves. If the market is getting worried about growth, it's going to get worried about stocks. Just trying to find a clean chart for you. This is just a pullback. Look at this trend, and this is just from October. We couldn't, even if that move, and we had this big down move, and big it was, we couldn't even get to the 38.2 fib of this move. So this at the moment, it looks like it's a decent move lower, but it's not even getting down close to these lows. I think I showed it, was it about the 50 fib-ish about the 50 fib we got down to that leg. So it's always worth keeping in mind context. Just because the economy softens and the market starts getting all dovish and, you know, panicky and whatever, doesn't mean this is going all the way back down to 4,000. Okay, you just need to have a look at your wider charts, and even this fib is nothing compared to this whole move. So, you know, these are why I use fibs and why they're important, because it tells you the longer term trends. That was just a pullback, not even getting to the 38.2 fib. This one just getting back to the 50 fib of this move before bouncing. So there's nothing breaking, nothing downward or broken trends, downtrends happening in this. Short term, yeah. Long term, no. So always make sure, say it till I'm blue in the face, look at the long term picture as well as a short term picture, because if you get sucked in to the short term picture, then you lose sight of the wider picture. Right, I think unless anyone's got anything else, we're going to call that a day for today. I'll let Kay take it easy today. Don't want to stress his voice out too much, and maybe he'll save some up for F.A.C.E later. So with that note, welcome back, mate, and thank you everyone for coming to the Flow Show, and we'll see you all tomorrow.